All right, welcome to this video that we'll title the RSI Masterclass 2024. I've produced these RSI discussion educational videos in the past, and I thought that now was a really good opportunity to kind of refresh this, revisit in 2024, and just to update and kind of streamline things a little bit from prior content iterations that I've done. So we're going to discuss RSI. We're going to discuss the horrible history of RSI and the way that it is just so poorly applied in the vast majority of instances, the way that the majority of the literature just focuses on this stupidly simple but also terribly inaccurate and yields very poor results in terms of its application. And we will be discussing kind of the correct usage for RSI, specifically in relation to crypto markets and the way that they operate, and then some of the nuances in the way that I use RSI personally. So I've been trading with RSI for years and years now, and it is my favorite indicator to have on a chart. It provides me with some of the most simple entries that I could ask for, but the simplicity is not taken from the existing way that RSI is presented. In terms of like the background to RSI and what we're really going to be discussing here, important to understand the context and the background to this as well. So RSI itself is a momentum-based indicator. It is something that illustrates the strength of the trend, the strength of the market, whether that be to the upside or the downside. And it does so by obviously representing RSI at various levels. Now, this indicator itself is something that is thrown out to new traders. It's something that new traders are kind of given as their first indicator to say, use this. And the way that it's typically used is through the overbought and the oversold levels. So the way that we operate around the 70 level and the 30 level on the RSI. And it's the worst fucking application that you could take for RSI possible. It is such a bad application. It's presented as this like really simple way of understanding the market, or understanding whether or not the market's overheated or not, or whether or not it's in that oversold situation. It's kind of been hammered to death. And actually, it's an awful, awful way of utilizing RSI. I've even seen some places, there's a place I've got on the screen here that says, it says here, like, if you're expecting a price reversal and we're above the 70 or 30 level, there's no telling when the reversal will take place or if a reversal will take place at all. Like, what a useless bit of information. Like, why even bother utilizing 70 and 30 for that purpose if your outcome is just going to be you don't even know if it's going to correct or not? So we're going to kind of like debunk some of the myths. We're going to look at the ways that I utilize RSI, and we're going to look at some examples from primarily BTC, but some other interesting discussion points along the way to kind of figure out, how we can make sense of this. So we'll go back into our discussions on the 70 and 30 level. And for the majority of this conversation, you can essentially take what I am telling you about the top side, so the above 70, the overbought indicator, and you can apply the opposite to the sub 30 level when we're into the oversold territory. I will do some clarification along the way, but typically speaking, that broad application of what I'm discussing on the upside will be applicable to the downside. Now, the reason that I'm going to kind of phrase it and present it in the above 70 manner is really, we know that the majority of money in this market is made on the upside. It's made on the long side. And also, because of the way that RSI works in the crypto market's history, RSI actually spends the majority of its time in the overbought regions, not in the oversold regions. And we'll take a look at BTC in a minute just to kind of illustrate that. But I'll be focusing really the conversation points and the examples on the overbought region. But like I said, just flip the logic into the oversold region if you want kind of the thought process for that. So let's dive straight in and talk about why overbought is such a bullshit term and why it doesn't really represent anything. Now, this is just a standard RSI. It's a 14 length RSI, which is your standard RSI. It's just got some nice pretty colors in marking whether or not we're in this above 70 region in one of the extremes, or whether or not we're at the oversold region marked in red. Now, The reason that this is like a terrible application, and you can just see even from us just scrolling the daily here, the amount of times that we kind of venture into this top region here. And I've marked out several examples that you can see in here where RSI gets into the overbought region. It's in that area where you would be led to believe that you should be kind of maybe selling, or you should be cautious about the market, and you should maybe consider taking profit or looking for short positions, depending on, where your interests are in the market. Because RSI is a momentum-based indicator, if you are long on something, you want your market to get into the overbought territory. There's no simpler way of me putting it. The fact that a market breaks into this overbought region is an indicator of significant strength of the market, which is exactly what you want to see if you're on the long side of a market. Because of the way that overbought is represented and discussed, it sounds as though it should be this scary thing, this thing that you should be cautious about. It's in fact the complete opposite. It's something that you should be happy about, and you should be excited when your market reaches those extremes, because it shows that there is significant strength in order to push the RSI to those levels. It means that we've got significant movement in the price action, and therefore you're probably in a positive position overall from, what your holdings are. So if we take this area here, we actually enter the overbought region here in October, 20th of October, and the market continues to run 65% higher. It's actually like a slight bit more, 65% higher, until the 25th of November. So you basically get over a month of price action through this region here, where we just trade higher. And not only do we just trade higher, but it simply doesn't give you an entry point into this market. So you can see here, it's anything but that overbought, be nervous, it might be weak, it might turn around, we might see a trend reversal. It's the complete opposite that actually takes place through here. You get zero pullback, you just get pure aggression the entire way up, and this runs for 65%, 66%. You then get another example of this at the end of 2020, the 16th of December. We do exactly the same thing. We run into January, into the new year. We end up running a 2x on this. Same thing again. Doesn't really give you a pullback, just continues vertically. We stay overbought for a significant length of time. And then there was just another example up here where we get another 30% on this, because, again, the RSI just stays in this overbought region and we continue to ascend higher. Now, down here is also important to acknowledge, and we'll talk about some of the levels of interest in RSI, and obviously 70 and 30 are something that I've been mentioning so far on the video. Notice the way that RSI bounces off that 70 level. So the way that the RSI just basically comes back to the 70 level, legs up again. Comes back to the 70 level, legs up again. When we are in strong trending market conditions, and when we have significant breaks like this and significant strength in the market, we actually see the 70 level almost become this, like support level within the RSI. Because the market is so hot, so strong, momentum is so clearly to the upside, we tend to hold on to this level and just bounce from it and continue higher. There's a little bit of kind of alpha about how to enter positions that are in aggressively trending markets as well. When we get those pullbacks to the top of the 70 level, it very often is actually a good place to long the market, not actually to look for shorts. So again, we're kind of flipping that existing and that basic bullshit knowledge like completely around. And we're actually saying, well, actually, we should be looking for longs. We should be aggressive in our positioning during these patches of time, because it shows that those markets have the strength with them. So our overbought levels, literally ignore them. We don't want to be considering them from any kind of negativity perspective. And I spoke about at the start the way that crypto markets in general tend to cling more to the overbought regions. We tend to extend further into overbought regions, and we tend to spend significantly more time in overbought regions than we do in these oversold regions. Right? So the sub 30 levels. And you can see from here, if you just mark off this price action here, all the way from here, we've got 2019 into 2024. We can see that we actually spend like consistent time above this 70 level, Whereas whenever we tend to get below the 30, we tend to bounce quite aggressively. So you can see here, we tend to do quite a lot more kind of V reversal stuff on the RSI out of this region than spending prolonged periods of time down there. Again, just inherently the crypto markets, strong uptrending markets, strong performing markets, momentum is typically always on the upside. Of course, we get patches of very nasty corrections, but they tend to resolve quite quickly when we get those. Again, if we look back even further from kind of 2015 through here, you can see exactly the same situation. All of these very aggressive moves back out of the oversold region, sub 30, a lot more time spent here in these overbought regions. And what we can see is obviously if we are ignoring the fact or ignoring positioning on a market because we're nervous about the fact they're in these scary regions in the extremes, we actually miss out on an insane amount of value. This is typically where the trend doesn't let you in. Those classic moments in which you're sidelined because the market is just so strong. There's a lot of conversation about whether or not RSI is a helpful indicator in trending markets or whether or not it's better suited for ranges, lower time frame, higher time frame, whatever it might be. This is where RSI can feel scary from a trend perspective, because you're doing something that's kind of counter the logic in which you kind of would have been conditioned originally to think, but shows that if you can understand the right signals that we're getting from RSI and from the trend, it's such a great trend following tool. It's so helpful for entry, assessing strength, and being able to position into these markets. And then we'll cover off, the divergence aspect. And the divergence aspect is something where the extremes are actually helpful to us. So we're not just kind of ignoring them, or we're not really ignoring them from the initial discussions anyway. We're just thinking about them in a different way. But divergences start to become helpful with the extremes added to them. And we'll take a look at the other BTC chart here for that, just because I've got it mapped out quite quickly and easily. And we'll take a look at the 3-day chart over here. So we take a look at this set of highs. And we can see clearly from an RSI perspective in the extremes that this is starting to lose momentum through these highs. Now, I'm not going to go into the definitions of the bullish and the bearish divergences. I hope that you're already aware of what those are. But this here is a very strong bearish divergence. We're getting that strong bearish divergence, and we get more confluence or confidence in that position because the RSI is trading and making these divergences in the extremes. When we look for divergence formation, we look for that to be occurring in the extremes of price or the extremes of RSI, because that typically yields the best results in terms of those turnarounds. So we see up here, BTC diverging, very, very nice kind of like signal region over here. And this gives us a really solid either short setup or reason to exit the trend, reason to exit our positions and potentially flip to the downside. So the extremes are helpful when we are looking for divergences. We don't typically look for divergences that are not in the extremes. Now, that's not to say that markets can't form them above the 30 or below the 70 level. I mean, BTC gets very close here with this one, across the highs here into 69,000. Gets very close here, and arguably very close here. But from a confidence in setup perspective, it's usually best to stick to divergences that are created in those extremes. Divergences that aren't created in the extremes tend to have a higher failure rate, and they're something that I refer to as in-motion divergences. And I can kind of like take us back in time to have a little bit of a look through this region here. Maybe we'll go one candle forwards. Let's go here, one candle forwards. And this would be a perfect example of a divergence in motion and the concept of a divergence in motion. This is taking place in the extreme, but you'll have to forgive me for that. So imagine it's taking place out of the extreme, or potentially we can even use this as a wider discussion for divergence creation in general. A lot of people would be tempted to do this and would be tempted to start doing this. People are necessarily not wrong here. They are just very early in determining that this is a divergence or a potential divergence. Again, remember, when we're trading divergences, we're taking the opposite side of the trend. When we're looking at, for example, shorting this market, this is a market that is significantly strong and is going to be very awkward to try and position on the short side for. We're adding kind of even more difficulty into the mix by the fact that we're trying to anticipate this divergence early. We're trying to say, well, I think this is going to diverge. And this is where that divergence in motion comes from, is what we're doing is we're anticipating the divergence, but the price action is still developing. And therefore, we do not know if we are going to invalidate this potential divergence or whether or not we're going to confirm it. So as the price action continues, you can see you're all fine here. You're all fine here. Starts to get you a bit of a sell-off, and then before too long you get yourself stopped out over here on the creation of the last high. So these divergences in motion can be very tricky. One thing that you're looking for is confirmation that a divergence is going to lock in, and one of those things is looking for a turnaround on the RSI. So you're looking for a situation in which if you're mapping out this as your divergence, here and here, you're looking for a confirmation that this divergence is going to lock in. And keeping the bigger picture in mind at points like this is also very important. So understanding that if you're looking at shorting BTC back here in 2021, you're looking at shorting what is the end of a trend. So you're very much early in terms of the process of shorting this, whereas people think they need to be positioned, right up here in order to make this an effective short, right? Like this, and then they're aiming for like this. You've got a lot of time in order to try and position into this and wait for that confirmation. The way that we take confirmation is by the RSI actually turning around and showing us that price wants to move back in the opposite direction, whether that be to the upside or the downside, if you're playing bullish or bearish divergences. And we want to see that turn around in RSI and it move back down. Now, you may be thinking here, well, you've got an example on the screen which is showing a divergence that failed. And yeah, like that's the reality, right? Trading signals fail. This isn't a perfect approach. It isn't a perfect indicator. It produces things that sometimes stop you out of position. This is a very good example of this. You take your, let's say you take your short position here. You take your stop loss above the last candle here on the movement down. You'd aim for fresh lows, maybe a retest into this region down here. And unfortunately, the price action would come up and stop you out. But I kept this example on screen for a very, very good reason, and that is because one of the other things that we look for are triple divergences. And triple divergences are pretty common when it comes to crypto. These markets tend to be pretty aggressive. They tend to give prolonged periods of upside and prolonged periods of downside, kind of like final fuck you moments to the end of trends or reversal points. And triple divergences tend to be a very common thing. And this area here, again, is a very good example of a triple divergence. Technically, this divergence should be called a double because there's only actually two divergences present, but because we use three highs, I tend to refer to them as triple divergences. So you can see through here that obviously when we continue the price action and we know the result of this because we've covered it off, we then get this situation that develops. We get this extra high, we get this area here, which is now our third lower high, and we're now looking at shorting into this instead. Okay, now when this situation develops, when we get triple divergences in crypto, that is typically a very good opportunity to be positioning. Whether that be on the bullish side or the bearish side, whether or not you're longing or shorting, it is a very good opportunity when you get triple divergences in order to position into a market. And again, when we're talking about the concept of being early or being late into a position, when it comes to triple divergences. Sure, you might need to wait a little bit longer to get that confirmation. You might be entering into a 3-day candle or a daily candle that's already 10% down, but you know that there is still potentially significant downside or upside that can be achieved. And so you're not, again, late. You're still probably, from a trend reversal situation, pretty early in terms of the way that this looks. And from BTC's perspective here, you get a really nice kind of area of price action, and you get a significant play out to the way that this works. You end up down here with a full 50% short position. Sure, your stop loss has to be wide. It can be altered once you get this price action that develops and we break the low. And the setup turns into something very, very nice. And just through that planning, maybe one failed setup, another go here, you capture a significant move in the market based on the fact that there was a clear signal of declining momentum operating in the extremes of RSI, allowing you to position comfortably into the short side. Now, in terms of a more recent example, we've got the trade on CRV, which is something that's currently in motion here, something that I'm in, and is taking place on the 3-day as well. And no wonder that's blowing my mind, because we're not on the latest price action. We can see down here, we've got our situation here, the opposite of that BTC chart, where we've now got our 3 lows here, and we're looking for a significant move to the upside. Again, we can start to think about the way that we're positioning into this. Can start to look at this as a single divergence through here, and then we get the third leg on the way down here. Again, stops everybody out here that's playing into the second or the single divergence. And then we get the third, and hopefully a good return on a bounce to the upside. It's already about 30% up. Target point's about 70% up, but the market is already kind of 90% up from the very low down here. And so has already represented a significant bounce in price action counter trend, which again, we know we're doing with divergences. So the 70 and 30 points are most helpful to us for either bounces, if a market is incredibly strong, or for utilizing it in conjunction with divergence creation. So the fact that we can set up those positions with divergences in the extremes tends to give a far higher strike rate. We can look for single divergences, or we can look for those triples, aka doubles, and we can look at playing on the back of those. The one thing that you have to do is it's all around positioning and the way that we position into markets, especially if you're utilizing divergences and you're playing counter trend into some of these moves. When you trade in markets that you know have the ability to create these triple divergences, you need to make sure you're planning ahead for that situation. And you can do that in a couple of different ways. You can either do that from the perspective of taking this trade, for example, by itself and saying, look, I'm going to play this because I think it's a single divergence, and I think it's going to run up to here and get a retest. But if it makes a triple, then I'll play it again. I'll get stopped on this position, but I will play the formation and the creation of a triple divergence as well. That's option number one. So you accept the fact that you're playing this as a single, and if it turns into this, you will take another chance to try and play that from here. The other way of doing this is through your positioning process. So what you may choose to do instead is you may say, well, what I'm going to do here is I'm aware of the situation of this creating a divergence, so I'm going to take a little bit of position here. Then I'm going to wait for a little bit. If this makes let's say a 12-hour support resistance flip, then maybe I'll add a little bit more. Let's maybe add a little bit more here. And then you see the market sell back off through this level and start to trade lower. But again, you've been anticipating that happening. Now we get the triple. You say, okay, well, it's time to load up here. Time to load up more now into this response that we're getting. And we end up with an average somewhere down here. But we're anticipating ahead. So we're not stopped out when we get something like this. We're using it as an opportunity to add to the position and making sure that our risk is managed through the entries that we're taking in regions like this. So a couple of different ways that we can try and think about positioning into RSI divergences. Okay, so that's RSI divs and the extremes covered off. And then we'll talk about the other most important area of RSI. And the other most important area is the 50 level on the RSI. And there are so many examples I can take from this, but I'll probably head over to the NASDAQ to show you just the way that this operates on the NASDAQ. And this isn't the chart. I'll swap to that in a second, but I want to give a bit of the discussion around why the 50 level is so important. Earlier in the video, I discussed the fact that people don't, or kind of argue about whether or not RSI is good for trending markets or ranging markets. And the reality is it's actually good for both. For ranging markets, things like divergences into resistances or supports are very, very strong signals to take trades, because you have these fixed parameters around your support and resistances. The market is locked down, the volatility is lower, and you can play these divergences as very strong, simple signals in a range-bound environment. In a trending environment, as we've seen from the discussion of the overbought and oversold levels, it's where old information on the RSI leads you to believe that for trending markets it's bad. It's not. We're going to refresh the thinking and start tuning in slightly differently to the way that RSI can help us in those trending conditions by appreciating strength, by appreciating weakness above and below 1730. And the other way that it's incredibly helpful is through the usage of the 50 level. The 50 level becomes almost a market reset button. So that's why this 50 level is marked out here on the RSI. It becomes this moment in which the market tends to react very strongly when it is trending. And what we can see from the NASDAQ perspective is very easy and very simple. And I refer to the 50 level, but we're not talking about an exact figure here. If this drops to 47, we're not saying, it's below the 50 level. It's not going to work out. It's giving me a different signal. Some common sense to be applied around the 50 level, but that's just the way that I refer to it as. So we can see with the NASDAQ here, there are some very, very clear and simple signals for us for positioning. First one we've got down here is this breakout point that we've got from the NASDAQ correction. So we get the huge correction from 21 into 23. So we just kind of, grinding down throughout this patch of time. We start to break out of this structure. We get the weekly higher low down here. We start to push clear, and the RSI and the price action afterwards comes back down over the course of 5 weeks into this 50 point where it now begins to impulse away. So it now begins to make its push. And we get that very simple signal here. We get the break of the 50 level. We get the correction back into the 50 level, and then we start to move to the upside. We get another correction in the market. We dip to slightly below the 50. We ramp up again. We get another correction, which takes place over 4 weeks. We hit dead on the 50 level. We bounce again to fresh highs. We get another correction over the course of 4 or 5 weeks, hit the 50 level, and we'll see what happens from this point onwards. The 50 level, regardless of time frame, is very, very important. It becomes this reset button for trending markets. Doesn't matter if that's on the 5-minute chart, the 15-minute chart, hourly, 4-hour, 12-hour, daily, weekly, monthly, yearly, whatever you want to look at. All the same concept. When you have a strong trending market, like the NASDAQ here, this is a very easy signal and very easy position in order to add, whether or not add to an existing position or bring in new things into the portfolio when we get these resets. The way the 50 level is also used is from a change in momentum perspective. And so we can visualize the RSI as a bull and a bear side. When we're above the 50, we're in bullish territory. The bulls are in control of the market. The bulls have control of the momentum, and we expect the more powerful moves to be to the upside. When the RSI is below the 50 level, the opposite is true. We expect the bears to be in control, the downside to have the majority of the volatility, and obviously prices to trade lower. The interaction between switching sides of the RSI is quite important to us, and especially on the higher time frame, it can very often dictate the next several months of price action based on the way that we operate around that 50 level. And so we can see when we start to look back on charts, and we can do so from a weekly perspective or a monthly, the higher time frames tend to work a little bit better just for presentation. We can clearly see that the time that the market spends here obviously correlates very, very well to the way that we see price action moving through these zones here. It just stays above that 50 level, nice and clean. Bulls are in control. All of the momentum is coming to the upside. Obviously, this situation here, we change, we drop underneath that 50, and we get this patch here of the downside. And then what do? We get that situation we talked about in terms of the setup here, where we break above the 50, and instead of failing, we hop back down for a retest, and then we start this patch of price action. Right? So here we are here. Right, so those 50 touches, those 50 breaks, very important in terms of who controls the market, where the trend is heading, and where that momentum shift is potentially starting to swap hands. As you see, this is where the bears essentially stop having the control of the market. This is where the bulls take over, and then the bulls really push things hard through here. Again, from a higher time frame perspective, essentially the same thing. We can see that the NASDAQ throughout this patch of time here, all the way from 2010, we can even take it back to 2009. So 2009 all the way through to 22 in here, just above the 50, clean uptrending price action on the highest of time frames. Little patch where the bears are in control down here, breaks back above the 50, March 23, and we know that's when the market starts to turn around again. Clear strength and momentum back to the upside. When we take a look at something like BTC, if we want to take a look at the crypto equivalent here, we can take a look at weekly price action through here. Very, very similar in terms of the picture that we're presenting here. Okay, we get this patch of price action through here. Again, we get our little drop here to 46s, but it doesn't really kind of deter too much from that 50 level, and the market trends very hard through this patch. We get our patch here, where the market downtrends, again, below the 50 level, trap below the 50, and all of the downside price action. We get a really great bit of price action through here, which is around that 6K nightmare zone from anybody who was trading during that patch of time. And we can see here that the RSI really struggles to break back above that 50 level. So you can see the market conditions are poor during this patch of time, really struggling to generate any upside momentum whatsoever, and eventually the market turns around and crashes. Maybe crash is a bit extreme, but it was a bad sell-off. So the 50 level can often also be proxy support resistance, and it's not really. It's just the way that momentum is struggling to break through and to basically relinquish control to the other side. So we can look for the interaction at the 50 level and the way that price is responding to that in order to take our entries. And again, we'd be looking at attaching additional pieces of confluence to that in order to try and determine whether or not we're in a good position to, short or long the market. I'll see if there's an example here on POPCAT. Off the top of my head, if I remember, this is relatively decent. Yes, a very, very good example. And that wasn't set up as well because I've got a successful trade on here. That was literally just from memory of thinking about RSI interaction here. So what we get on POPCAT through this region here is, again, you can see POPCAT nice and strong, holding through the 50, holding through the 50 zone here, getting the retest up here initially, selling off, getting back to the 50 level, fresh rotation of momentum, fresh highs established. And what we do is we get this aggressive sell-off through August, get back through, break through the 50 level. We get one little small retest in here, which is quite nice on that green daily, and then sell off again. But this one here is the very, very clear one. We trade back into an area that is former resistance, okay, through here, trade into here, and the RSI resets at this 50 level, and then the market rejects and turns around. So what we're doing here is simply combining the fact that the trend is now to the downside. All of the momentum is clearly on the downside. We would like to join that. We want to join that trending market. Price moves up, hits into this daily resistance level. At the same time the RSI hits the 50 level, trend is down, opportunity to open up a short position. Market starts to sell off and react to that level. These points here, very clear flip points in trending markets on whether or not the trend is going to carry on or turn around. So the 50 level, very, very important to the way that we think about RSI, and we utilize RSI for trending market conditions. Like I've said, it can be very, very easy, simple from a higher time frame perspective to capture trending moves when we get these reset points. NASDAQ, very good example. POPCAT, very good example, both on the upside and the downside. And it can help shape our bias. It can help shape our thought process when we just simply think about the market like this. Right? Like, do you want to be positioning on the long side if the RSI is below the 50 level? Probably not. We can wait until it gets back above that 50 level and we know the bulls are in control, and then we can ride with any upside trend. Any caveat to that would be if we're making bullish divergences in that sub 30 zone, then of course we would also look at positioning into the market on the long side there. The other thing to discuss around that 50 level, and the final point for this, is probably areas like this. And sometimes this happens. And all this is doing is this is just indicating that the market is choppy. So the RSI is just failing to do anything meaningful either side of this 50. It's just cutting through it back and forth. And if you get situations like this, you're either taking signals from a lower time frame perspective or a higher time frame perspective to be able to try and see through what's going on in ranges like this. But any time that we're just chopping through the 50 level, good indication that the market is obviously also doing the same. It's just chopping around, and it's not going to be a great kind of time frame for us to be utilizing for trading. So I hope this video has given you a nice overview to the way that we can utilize RSI, and has blown away some of the myths and the common fall down points. And it would probably be wrong of me to end the video without the discussion on drawing divergences. And this is a point that people used to tag me on Twitter all the time whenever they saw bad examples of RSI divergences being drawn. Because the length of the RSI is set as default to 14, we only ever look back over the last 14 candles for divergences. So when you get people that start to draw divergences that are ridiculously long in length, okay, so they start drawing them and they're basically like covering price action that looks like this. Okay, and they're saying, well, I think that this is a divergence here, or, you know, they're starting to do like crazy stuff like this, and they're saying, well, I think from here to here, okay, this must be a like a hidden bullish divergence because I can see this. So I think, you know, there's something here. It's this might be a div. Nonsense. These points here aren't connected. They're not relevant in any way to each other from an RSI perspective. So we look back over the last 14 candles. Now, when you look at stuff like BTC and we think about that divergence that we mapped out on the 3-day time frame from the highs back here, of course, now this candle, if we go from here to here, this is more than 14. But between our divergences, between these areas that we're looking at, there is less than 14 candles between each of these diverging areas. So we've got our divergence here and our divergence here, and each of these are below 14 candles, so we're allowed to utilize this to form this triple divergence. when we're starting to do things, like here to here, that is just incorrect. The other thing that I tend to do is divergence playout is a very common fall down point for people, or an area that is a little bit more subjective when it comes to playing with the RSI. So people often say, well, how do I know when a divergence is played out? And the very simple answer to the way that you know that a divergence is played out is the price action that follows a divergence. Divergence playouts tend to be very aggressive, and they tend to be very clear and obvious that aggressive price action has formed, and so you know the divergence is pretty much done and dusted. You're looking for increased aggression and strength counter trend. So when you've got a triple divergence like this on BTC, and then you get a 50% sell-off in the market, that's your divergence playing out. So that's very, very clear and easy to understand. Significant pieces of price action that follow the creation of a divergence are where your divergence is played out. The other way of thinking about it is, again, utilization of the 50 level. So when you get strong divergences like this, especially on the higher time frame, you are looking for crossovers in the RSI, whether or not that be because you've taken position for a bearish divergence to the downside or a bullish divergence to the upside when that divergence is played out. So you want to see the RSI crossover, the resulting price action, resulting volatility, and then that's your divergence played out. So there's a little bit of subjectivity in it, but in terms of seeing the volatility and seeing the aggression in the price action, doesn't matter if you're on the 5-minute time frame. Obviously, you've just got to kind of scale back the percentages. You're not going to see a 50% move on the 5-minute time frame. But that's the way that we're going to start thinking about divergences playing out. Highly volatile price action and aggression, or crossovers of the RSI to the opposite side, and then thinking about closing out the position. We're not looking at timing the absolute bottom or top of a trade. We're looking at extracting maximum value, and that consistently is the best way of doing that, through taking those as our opportunities to exit trades. A lot of the time, especially in crypto, we look at things and we've captured a move that did minus 50% to the downside, but somehow we're still holding on to the position because we've now joined the camp where we're thinking everything goes to zero. And so we'll just hold on to that position. And again, we know how quickly crypto can change. And all of a sudden, 3 days later, we're suddenly, we've gained 25% in the following 3 days, and our unrealized P&L is getting hammered. We take the opportunity to exit at those volatile points and allow that to be our divergence playout points. So like I was saying before I got distracted by giving you a couple more points at the end, I hope this video has been helpful in understanding RSI a little bit more and the ways that RSI can be very, very helpful to you both in ranging environments and in clean trending environments. RSI is a great tool for being able to join those trends in motion, anticipate potential trend reversal points or areas that you should be cashing out into spot. And it can also provide some very simple simple trade setups, right? Whether that be for lower time frame traders who are looking at scalping, which is what I used to do with the RSI before my focus shifted into swing trading and longer term trades, utilizing again the same signals but applying that out to those higher time frames. If there are any questions on this, you know where I am on Twitter. Always love to discuss RSI. It's like the geeky love of mine. And thank you very much for sitting here for the last 45 minutes listening to me talk about an indicator for the 1970s.